Welcome to episode 5 of the Confessions of a Dealmaker podcast. I'm your host, Jason Godwin. Today's guest is Justin Munizzi. Justin, welcome to the podcast.
Thank you for having me, Jason. I'm excited to be here today.
What is it like prepping a seller to go to market?
A lot of what we do goes beyond just the technical, tactical services of being an attorney. Sometimes it comes down to just being a good counselor.
In a business transaction, you have to trust the person. You have to build a relationship because you're buying something you can't see.
Yeah, if I had to pick one thing that I think is the biggest predictor of whether a deal will fail or succeed, do the parties trust each other? If it's somebody who's poured their blood, sweat, and tears into the business over the years, they've got a lot of ego and emotion attached to that.
If you can just do what you say you're going to do and exceed people's expectations, your business will grow on its own. Hello, everyone. Welcome to episode 5 of the Confessions of a Dealmaker podcast. I'm your host, Jason Godwin. Dealmaking is a profession upon itself, the world's highest paying profession. Things don't just fall into place by accident. A good dealmaker understands that it's their job to finesse things into place. When I was looking for a quote for today's episode on the subject of dealmaking and what kills deals, I couldn't find the source of this quote, but I know I'd heard it before. When we knew we were going to talk about this topic, I knew exactly who I wanted to have on as my guest. This person has helped close countless business transactions and is one of the foremost experts in the state, I believe, on business transactions. Today's guest is Justin Munizzi. So Justin is a graduate from Stetson University with a bachelor's in business administration. He graduated from Barry University with his law degree. Justin is the founder and managing partner of the Munizzi Law Firm. The Munizzi Law Firm specializes in business law, residential and commercial real estate transactions, title, and then also M&A. Justin, welcome to the podcast.
Thank you for having me, Jason. I'm excited to be here today.
Excited to have you too. So when we knew this was a topic we wanted to talk about, which is what kills deals, I couldn't think of a better person to have on. You and I have been in the trenches on dozens of deals together over the years, and I couldn't think of a better person who can share their wisdom on how to keep a deal together.
Yeah, it's so funny because M&A is a different animal than real estate transactions. It's a longer life cycle, first off. Residential transaction, you might be living with the seller or the buyer for 30, 45 days. A business deal, you may be living with them for 6, 8 months, maybe more. And so you really have to get along with people, and things can sometimes go sideways when parties have the wrong motive or they have different expectations. And so we have lots and lots of stories, as you're aware, some that we've shared.
Do you remember how we met?
I do. You want me to share it?
Well, I would love to hear from your perspective. I actually went through my old inbox trying to find the original series of emails, and I could not find them. But yeah, I'd love to hear from your perspective or how we met.
Yeah, so I think we merged emails in 2019, or I should say we changed domains, and so I think I lost the emails from that time period as well, but it would be fun to see them. I think the way we met was that my father had a commercial investment property here in town, and at the time you had a Matco tool franchise, and so the commercial property had a tenant. The tenant basically paid his first and last month's rent, got up and running, and after a few months, skipped town, disappeared.
Yep.
He left behind a bunch of stuff, but he also took a bunch of stuff with him. And so we needed to actually terminate his possession so that they could relet the property. So we filed an eviction suit. And you reached out to me because you had the Matco tool franchise saying, hey, look, I rented some tools to this gentleman, and can I get in there and see if he left anything behind? And I remember thinking, this is probably an adverse party. I don't know if we should be talking to him, but all right, fine. It sounds like he's sincere. He's just trying to get his tools back. Okay, fine. And I think we had a few conversations. I think you were able to get in there, and at that point, he had already taken all the tools with him.
Yeah,
if I remember correctly.
Yeah, I think what happened is they were there for maybe a few months. They closed down shop very quickly, and I remember I think I went to the property appraiser site and then went to Sunbiz to figure out who the registered agent was, and I found your firm, and I think I called your office, and it was like and you were like, why are you calling? And then but through that, we built a great relationship because we've been able to work together in so many different transactions now. And it's been a great, not only business relationship, but a great friendship.
Absolutely. Yeah. It's a funny beginning. But yeah, I was glad to have met you. And it was also a lesson for me that I've tried to implement throughout the years, and, just treat everybody with respect, treat everybody fairly. it's amazing how far that will take you.
Right. I mean, in business in general, I've learned that too, is to give people the benefit of the doubt, because you never know what relationship you might make that in the front end you may not think, oh, well, how is this going to be beneficial to me or the parties that I help? But then all of a sudden in the future, you realize, oh, wow, this person can help, and or they're just a great relationship to have. So I try to now have an open mind when I'm meeting people, because you never know. I mean, there's so many meetings I've taken, I'm like, wow, this just doesn't seem like this would be a good use of my time. But then all of a sudden, like, oh no, this is a great partner, referral partner to have, or person to know that I can send them clients, they can send me clients, or I can help serve their clients, vice versa. And it's like, I'm always surprised how that works.
Yeah. Yeah, I'm reminded of a quote, and it's certainly not mine, but business development has more to do with farming than hunting. And I don't know who said that, but I think it's true. Hunting is you go out and it's a 1-to-1 ratio. You kill something, you bring it home, you eat it. Farming, you're planting seeds, and you don't know which ones are going to sprout and which ones are going to die. And so we're planting seeds all day long, all week long, all year long with the business development. And you're meeting people that, there may not be any relationship that comes to bear from that, but sometimes it pops up and it becomes a great relationship later on down the road.
Absolutely. Yeah, no, and I would say in your industry specifically, it's very relationship focused. You're a part of the BBF, and you're one of the, I would say, number one attorneys in the BBF now that people are looking to for business transaction advice, closing, support, title work, because you've been able to get the job done, and you've been able to get deals that on the front end didn't look like they were going to be able to close, and get them to close. And that's not by accident, right? That's by, and I'll speak to your abilities and your team's abilities. That's because of the way that you manage transactions. And so, for anyone that's wanting to grow a business, start a business, or take a business to the next level, if you can just do what you say you're going to do and exceed people's expectations, your business will grow on its own, right? So that's along with the farming aspect and building relationships, you'll be able to have a great reputation that precedes you, and people will seek you out for your services, right? And so you become one of the foremost attorneys in your field because you're so good at what you do and getting deals across the closing table, right? Because you've got the experience, and also there's kind of a sense of, I think, an instinct you have to have in being a deal maker to know how to help parties communicate better and to understand each other, and then also to figure out what each other's needs are so that you can get those deals at the closing table.
Yeah, absolutely. There's two things, and by no means do I think I'm, the expert in this field, and I appreciate you saying that. I think there's a lot to learn, and maybe that's something that I do well, is that I'm always willing to learn, and I do try to do that from every transaction. So at the end, we sit together as a team, and we say, okay, what went well? What are the things we can improve on? What can we do better next time? And I always look for something, whatever it may be, however small it is, there's always something we can do to improve. But as far as the relationships and the sellers or the buyers themselves, a lot of what we do goes beyond just the technical, tactical services of being an attorney. Sometimes it comes down to just being a good counselor. And what that may look like with a seller, for instance, is saying, hey, have you thought about why you're selling? It's such a basic question. And you do a great job of prepping your sellers and making sure they know the why. Some brokers maybe don't take it that far and don't necessarily do as much of that. But getting a seller to really understand, why am I selling? Is it just for the money? Is it because I want less stress? What is it really? You have to peel back the onion a little bit. And so good communication, getting them to see themselves from a different perspective, see the transaction from a different perspective, can be helpful.
I never really asked you this, and it's probably, I didn't want to going into this conversation so that we can have this to talk about now. What is it like from your perspective prepping a seller to go to market, and what conversations are you having outside of just the why, and what are some of their fears, concerns, or the things that come up that's keeping them up at night when they're going to market?
Yeah, well, there's a lot of things. I mean, right off the bat, I think it's the fear of rejection, especially if it's somebody who started small and has grown versus somebody who bought an existing business. So if it's somebody who's poured their blood, sweat, and tears into the business over the years, they've got a lot of ego and emotion attached to that, understandably so. And I can relate. I started my business small as well. And so they have to be able to see things objectively and also not be afraid to put themselves out there. And so going to market is kind of a bit of self-revelation. You're revealing yourself to the world and saying, okay, here's what I've got, for better or for worse. And so getting over that, I guess, initial fear of rejection. Another one is, and this is more of a legal concern, is scaring off your employees when they find out that you're selling. And that can be overcome in various different ways, confidentiality agreements, the way that you market to buyers, obviously getting a buyer to sign an NDA prior to revealing anything. But that's another fear, is like, hey, if my team finds out we're selling, are they all going to run? So that's just a few things that come to mind.
Yeah, no, we've had some of those same conversations, but the one I haven't given much thought to is the putting themselves out there and the fear of rejection.
Yeah.
That's good insight. I haven't thought about that.
Yeah. And again, that's beyond what an attorney is really trained to do or think about. It's more psychological than anything.
Right. Relationship based.
Yeah.
Yeah. So I think what I've noticed in this business, which is not how I thought it was going to be coming into this, and I think that's also why people who come from a real estate background somewhat struggle in this industry, is it's so relationship focused.
Absolutely.
Which I think that's why we've done a good job if we've taken that approach. But when you've had experience in real estate transactions, which are somewhat, I wouldn't say adversarial, or contract negotiations where you're trying to get something from the person and you're trying to win. You may never meet them. You may never have to look them face to face, right? And in a business transaction, you have to trust the person. You have to build a relationship because you're buying something you can't see. I always say if we're buying a piece of real estate, I can hire a business or a building inspector to go look at the building and tell me the condition of the building. We can hire an environmental company to do a phase 1, phase 2. I can hire an attorney in the title service to do all the deed investigation, title work I need to do to give me a good understanding of the property. I can review the financials and get lease estoppels, and I can make a decision without ever leaving my office. But with a business transaction, that's not the case, because you're buying a living, breathing thing that you really can't physically see. You're looking at a series of processes, people, technology, and information that produces revenue, that provides a service and produces revenue, and you have to investigate how that performs and build a relationship with the seller to understand if it's something you trust.
Yeah, no, absolutely. And that's a great point. It is so different than real estate transactions. Like you said, real estate transactions, you can touch it, you can see it, you can quantify it, you can dissect it through inspectors' reports and title work and all that stuff. And in a sense, it's less personal, because a buyer and a seller can both sit there and look at the property and focus on this other thing that may or may not have issues, right? When you're selling a business, it's so much more personal. If there's a defect in the business that the buyer finds, or some issue that they don't like, a seller is going to, or may very often take that personally, because what they're really saying is, hey, you didn't do a good job with running this business. You did something wrong. And so that's a totally different sort of conversation.
Right. And then also when you're negotiating for an asset, it's a quantifiable thing you can physically see, and there's usually a known price. There's data you can use to quantify your objection to the asking price, or your support of your asking price if you're the seller. So you can negotiate a position based on information and data. In a business transaction, it's more personal, so you really don't have that high ground to stand from, whether it's a previous sold price or your support of your asking price. So it's not the same negotiations. And I think a lot of people take that for granted going into a sale. And so they get themselves in a position where they're going to be adversarial in a way. It's like if you're going to go, when you're meeting your wife for the first time and you're trying to date her and you want to understand who she is, you can't be adversarial and try to pin her in a corner with words or with contract language. Like, all right, well, so if you don't do this, then this is what's going to happen.
Right. Yeah.
It doesn't work.
Very true. Yeah. Very good point. Yeah. Business closings are very, very relational. And, so, one of the things that I like is when the parties do spend some time together before they even think about doing a letter of intent or an offer, and get to know each other, because they got to know the process. They got to know what the business looks like. They need to know how the seller has been thinking, all these years that they've been running the business, and make sure that their thoughts are aligned and that their expectations are the same.
Right. Yeah, no, I've seen the number one thing I've seen that leads to success in business transactions is two parties that get along, two parties that understand each other, or at least they're attempting to understand each other, and they're being objective about the business and having open conversations and dialogue. Whenever there's a lack of openness in the relationship, issues tend to show up at the very end of the deal when you're the closest to closing, and all of a sudden now trust may be broken. It's harder to bridge that gap and get the deal across the finish line.
Absolutely. Yeah, if I had to pick one thing that I think is the biggest predictor of whether a deal will fail or succeed, it's going to be the trust. Do the parties trust each other? Are they thinking the best about each other, or are they expecting the worst? If the seller believes that the buyer is out to get them and they're looking for every advantage, whether it's actual evidence to support that or whether it's just perceived, if they don't trust the buyer, it's going to be like rolling a rock uphill the entire time.
Yep. As you and I have experienced in the recent past. And the same goes for on the buy side. If the buyer has some distrust from the seller, if they think the seller is withholding information, they're not being transparent, they're not communicating clearly. And sometimes sellers don't communicate clearly because they may not have the language to communicate clearly, or that they don't have access to the data the buyer's requesting, or they maybe didn't keep those records that accurately for that topic that they're looking to review, and they think the seller's being invasive, and it's just simply that it's just poor communication.
Absolutely. Yeah, and I won't do my my industry any favors by saying this, but I will say sometimes when there's multiple attorneys involved, it can get really messy. And the reason why is because you're now having multiple different conversations, but also types of conversations. And so you're going to have this
interest too.
Yeah, absolutely. Yeah, you're going to have this formal legal conversation going on between the attorneys, and then the buyer and the seller are maybe having their own conversation. And then you may have the agents, if there's a listing agent and a selling agent as well, they may be having a conversation. So you could have up to 3 different conversations between 6 parties, plus others maybe, going on, and it just really can muddy the waters. So as much as I do obviously think that parties are entitled to representation, and many times both sides need it, if the attorneys are not doing a good job of keeping the parties together and facilitating good communication, it can go sideways when they start posturing.
Right. And then you'll have in my experience, it's been sometimes a third party, an outside party's attorneys that come in, that they all of a sudden start posturing out of nowhere and pounding their fist on the table saying, oh, this is the way that this language has to be in the agreement. This has to happen this way.
Yep.
And, I don't want to kind of jump ahead too far, but knowing that may come and being prepared for it will help alleviate the tensions when that situation comes, right? Because the more, like you said, the more attorneys on a deal, the more the intermediary and the actual closing attorney need to be aware that there will probably a problem will probably arise, and you have to have a plan for how you're going to handle it, and you have to start asking questions early on so that you can prepare for that as soon as possible.
For sure. Absolutely.
We had a deal. I remember the most complex one we had was a gas station liquor store transaction. So in that deal, we had a closing attorney. We had the individual parties' attorneys. We had a title agent because the seller refused to use the closing agent for title.
Okay.
We had a fuel supplier that had first right of refusal on the property and had his attorney involved.
Oh, boy.
There was an attorney for the liquor license. The lender had their own attorney involved. And there was another one that popped up for another reason. I can't remember what it was. Yeah, I think I had to do something with the lender too. So the lender may have had 2 attorneys involved. And we were literally negotiating at the closing table still. We were at the closing table post-inventory, and there was still things that were being negotiated on a conference call with all the parties involved because there was just so much ambiguity because there was so many interests in that deal.
Let me ask you a question. Did those attorneys, however many there were, how many, 6, 7?
Something like that.
Did they ever meet face-to-face?
No. Well, the closing attorney was that was at the closing table. So no one ever met face-to-face besides the broker and I and the buyer-seller.
Yeah. Yeah, and so in these days, Zoom would even be fine. But I think that, again, the attorneys, we're trained sometimes even to do the opposite of what's conducive to making a deal work, to try to find the faults, to think the worst, to try to find what the other party's hiding. And so when you have that many attorneys, it can get very complicated if they're all just sending emails back and forth or talking over each other. So I like it when things start going that way. Just say, well, let's have a timeout. Let's all sit together, whether it's Zoom or in person. Let's look at each other You know what I mean? And so that we can see each other face to face and work through these issues and try to come up with a plan, because we're all on the same team, really. We're all trying to get the same thing done. If you can see it that way, you can start being creative and cooperative instead of adversarial.
Right. No, that's fantastic. I don't think enough parties take that avenue. And it's also, it's funny you say that. So think about this. This was a pre-COVID deal. And now that I think about it, I don't think we were using Zoom as much then. And now it's I would say most of our meetings are held through Zoom. So one thing we do is we try to get the parties on a meeting as soon as possible. Once the buyers express interest, we have a buyer-seller meeting via Zoom. And it's easier to facilitate than an in-person meeting. And start building the relationship before we go to in-person, especially if you have a lot of buyers who are looking at a deal. But we try to often, I haven't thought about it that we weren't doing this intentionally, but I've noticed that keeping the parties engaged via Zoom once every 2 weeks, once a week, those relationships seem to produce easier closings.
Yeah. No, and that's huge. I don't think enough brokers do that. And it's kind of the opposite of that saying, absence makes the heart grow fonder. In business deals, the opposite is true.
Right.
Absence makes the hearts grow colder.
And suspicious.
And suspicious, yeah. And so if you can keep them, if you can force them to keep looking at each other. I mean, we had a transaction not too long ago where this was the case.
Still have nightmares.
And without going into too much detail, these parties, when they were face-to-face, they loved each other. And they got along, and they hashed things out, and they would walk away with a pretty good understanding. And then a few days would go by, a week would go by, 2 weeks would go by, and then they're starting to think the worst of each other again.
Right.
And they would just drift apart. And so, yeah, if you can keep them in front of each other, it forces them to face their issues.
Right. Yeah. And so that's a good expectation to have, and a good thing to let sellers know before they go to market that, hey, this is a relationship-based transaction. You're going to have to build a relationship with this buyer for the buyer to trust you, and you're going to have to trust the buyer that they're going to have the best intentions in mind with the deal.
Right.
Yeah, that's good advice.
Absolutely.
So I'd love to talk a little bit about the transaction process from your perspective. I think a lot of people, that may create a lot of anxiety for sellers because they don't know what to expect.
Yeah. Yeah. So that's there's a couple different buckets, if you will, or paths, if you prefer that, of how we can approach a deal. So I'll give you an example. So a seller might come to us without a broker, and they may say, I'm thinking about selling my business. What do I do next? And so in that situation, if they're not already working with an advisor or a broker, I might encourage them to do that. I will usually do that if they don't have a prospective buyer yet, right? Because they don't know what they don't know, and they may think their business is worth $100,000 and it's actually worth 50, or maybe it's worth 300. You know what I mean? And so we'll encourage them to talk to a broker right away. But if they've already got if they've already got a buyer identified, then we will talk about, okay, what have you discussed so far? You know, do you have a term sheet, a letter of intent, something in mind? Just bulleting out the deal. If they don't have that, we'll assist them with building that. And we try to get them on the same page with just the fundamentals of the deal. And so in that situation, we might be representing one of the parties and doing the closing work. So we're wearing really two hats. We're representing a party. We're being the closing attorney as well. The buyer, or in the case that we're representing the buyer, the seller might get their own attorney. So there could be another party involved there, but that's one path. The other path is when we are approached by parties who have already reached an agreement, and they could be represented by brokers like yourself, or they may not have brokers, but they've already got the deal pretty much ironed out, and they're just looking for us to close it. So in that case, our deal is kind of more cut and dried. We're just wearing the closing attorney hat. You know what I mean? And so we're taking orders from them. We're drafting the closing documents. We're letting the contract speak to us on what the parties have agreed on, and then we're memorializing that with the closing docs. So it can go a few different routes.
Yeah, and sometimes there's a blending of the two depending on what could happen. So I think here's a good question. Oftentimes I have, and this is more of a buyer-specific thing, we'll get to a place where a buyer wants to make an offer, and we say, okay, great, so we're going to draft this agreement. We need to figure out this, and this. Who's going to be escrow agent? Okay, who's going to be the closing attorney? Well, what do you mean closing attorney? Why can't we use the title office? And okay, put the brakes on, right?
Yep.
Why would you tell a buyer or a seller they should use a closing attorney to close a transaction versus using their individual attorneys to play tennis with a closing packet, or having a title company do a business closing?
That's a great question. Yeah, and I've seen that before too. So the first thing is a title company is not legally allowed to do a business closing if there's not real estate involved. If there is real estate involved, they can do the real estate portion of the deal, but typically they're not going to be able to handle the business sale documents. So we're talking about the bill of sale, the conveying instruments, any of the sort of reps and warranties that go with the business assets. So they can't touch that. They can only do the real estate. The reason for that is because they are agents for their underwriter. Underwriter only issues title insurance, and so they can do the documents incidental to issuing title insurance, but they can't do anything else. So right off the bat, if somebody's saying, well, I'll use my title company, you have to sort of dispel them of that notion, explain to them why the title company legally won't be able to do that. The second thing about why don't the buyer and seller just each get their attorney and then sort of bat it back and forth, I think it goes back to what we were talking about earlier. Having a closing attorney involved, their job is to close the deal. And especially if they're not representing either party, that means they're representing the transaction. And so their job is pretty clear. They're to get the deal to the finish line. And so they have sort of a vested interest in keeping things on track and moving the parties closer and closer to closing.
Exactly. That's a great answer. Additionally with that, there's a lot of confusion around in a business sale, what is actually being conveyed. You know, a lot of times sellers are very confused on what are we actually providing to the buyer and what's the buyer giving to us and what needs to happen to convey those assets and items.
Absolutely. Yeah, and that's a great question too. Something to be addressed early on. If it's a situation where one party is thinking, "Oh, I'm getting the equity," and the other party thinks, "Oh no, I'm just selling the assets," obviously that has to be addressed pretty early on, right? So those are the two routes really. You can do what's known as a stock sale or a membership interest sale if it's an LLC, where they're actually buying the equity of the company. They're stepping into the shoes of the owner of the company. So that comes with everything that the business has. That means that they're going to be acquiring the liabilities of the company, the assets of the company, professional licenses that go with the company, and there may be compelling reasons why you might want to do that. To give you an example, I've got a current deal right now where there are some professional licenses involved and they belong to the business, and for the individual buyers to go out and get those licenses, it would take them years. And so instead of doing an asset sale, they're just going to do a stock sale where they're stepping into the shoes of the owner. So that comes with various pros and cons. The other alternative is what's done the majority of the time, which is an asset sale. So the company is the seller, and the company is selling the things that it owns to this new person. And this new person may have their own entity that they're going to acquire it in, or they may just be individuals. So those are the two routes you can go, and it's important to drill that down early on. Which one we're going to go with.
Yeah, we've had that conversation at the beginning of the listing process, and sometimes parties are confused as who the seller is. And it's like, well, you as the individual are not the seller. You're the authorized representative of the company, and you're signing on behalf of the company. And we have to have a corporate meeting minute that records that you are being granted permission to sell the company.
That's right.
Because the company is actually who the seller is. And there's sometimes some misunderstanding of what is actually being sold.
Yeah, and as a personal or a practical matter, I always make sure to have a CPA. If they don't have a CPA already, I try to get them connected with a good CPA who's familiar with business acquisitions and who can advise them on the tax implications and the financial implications on which path they pick.
Right, because they can be drastically different depending on which direction you go for different situations.
That's right. Absolutely.
So in your experience, we talked a little bit about relationships and what is best practices to help get a deal to closing. What do you see that gets deals off track?
So just a few things that come to mind. I mean, the seller not actually being ready to let go, the seller being too emotionally attached, wanting the buyer to do things their way. A buyer may or may not like the seller's style of doing things. They may just want the assets. You know what I mean? And they may have an existing business in that same industry and they're just going to bolt on the assets. So if a seller is really, really stuck on, you got to do it my way, and here's why I've been successful for the past X number of years, and you need to do it my way or the highway, that can throw a wrench in things. Unrealistic expectations on lending, and qualifying for a loan on the buyer's side. So if it's an SBA deal, as we know, that might take some more time to get it done. And if a seller thinks they're going to close within 30 days, they need to have a little bit of a reality check, and they need to realize that it might take a little bit longer, and they need to come to terms with that. They need to say that's not okay with me, and I want a different type of buyer. I want a cash buyer, or they need to settle in and be patient and realize it's going to be a process.
Yeah, so one of the new things, so we're rolling something out new in our process is kind of in our onboarding form is in our questionnaire is basically there's 5 options, and it's what's most important to you in this transaction? And those questions are based on time frame, and so that we can understand what the seller's expectations are. Is it you want to sell in less than 90 days? I think you and I have done one transaction that closed in less than 45 days. It was a cash transaction we did, I think, in the beginning of 2022 or into 2021. But that's the only one in my career that's closed in less than like 90 days.
Yeah. It's typically not a quick process. And
Right.
The reason for that is pretty obvious. The lender wants to make sure that they're comfortable with the deal as well. I think you said this, and it's accurate. Lenders are, yes, they're qualifying the buyer. They want to make sure the buyer can meet the financial obligations, but they're actually also underwriting based on the company.
Right.
They're looking at the seller. They want to see that the seller was making enough money with the business, the assets, all that stuff to make it work. So they're doing underwriting not just on the buyer, but also on the business itself, and that takes time.
Right. When we bring a business to market, one of our practices, and I hope I'm not giving away too much of our trade secrets, but we look at every deal through an SBA lens. Will this qualify for SBA lending? I think a lot of times the parties, whether that's brokers, sellers, buyers, they wait until someone asks for SBA, like, oh, now let's get an SBA lender involved, and now you're okay. That's cost you 3 weeks to get through like pre-qualification, and then you now have to underwrite the deal. You have to underwrite the buyer, and you've lost 45 days before you know it, versus doing that on the front end. Like, okay, we can get a higher price if we go with an SBA buyer. That is, until you get into the larger deal sizes, that seems to be the case. What I've seen is SBA produces higher exit prices.
Yeah, absolutely.
But it also produces high blood pressure, stress, anxiety, sleepless nights, and the more time you give underwriters to think, the more interesting questions they will come up with to ask out of nowhere.
It's very true. I think they stay up late at night thinking of questions to ask sometimes.
Yeah.
And the other thing, in terms of things that can get a deal off track or kill a deal, would be what I said earlier: attorneys with something to prove, attorneys that feel that they have to, attorneys that feel like they have to justify the retainer that they charge by finding problems and then trying to solve them. And the attorneys that do this type of work, M&A work, generally speaking, they have a solutions-oriented approach. If they're good at what they do, they're looking to make the deal work. They're looking for every reason to make the deal work. Now, obviously, they're not going to overlook problems. They have a fiduciary duty. They have a duty to their client to make sure that if there is a legitimate concern or something needs to be addressed in the contract, that we do it. But if it's something that really doesn't have that big of an impact, I've seen attorneys, and I'm guilty of this too in the past, you get hung up on a particular paragraph or sentence that you really want. You just really want it because you wrote it. And if you're not careful, you let your ego get in the way, and then you'll end up you'll spend a day arguing about something, and you're like, wait a minute, what impact does this actually have on the deal? It may not have any impact.
Right.
So you have to put that stuff aside and say, what's best for the parties? What's going to get them where they want to go?
Absolutely. One of the other things I've seen on the attorney side is not reading and responding to emails thoroughly, which I can say, working with you for so many years, one of the things that your office is amazing as communication, it's fast and thorough and detailed. And we know that whatever emails were sent, your team is reading and you're reading, so you have the full picture of what's going on. Whereas in other deals I've worked, it seems like the attorneys, a lot of times it's all outbound communication and they're not reading the inbound. So they're basically acting on their information and they're not taking new information in. So sometimes there's timelines that may not be met or things that were overlooked because they just weren't reading the emails thoroughly or participating in the communication. It was very much one directional.
Yeah.
I see that a lot on the lender side too. The lender's attorneys, you have to kind of slow them down, because people may not know about the lending process is it's a giant machine and it's a conveyor belt. And they're taking your deal and dropping it on the conveyor belt, and it's going down their pathway, and it's going to drop from one person's desk to the next, to the next, to the next. Right. And you have to be prepared for that. When it gets to the attorney's desk, they're stressed, and they've got 2 weeks to get this thing closed, especially if it's near the end of a quarter, because that's big in the banking world, is measuring things by quarters and bonuses and performance-based incentives. So they have a very short timeline to work on that project, and they may not be privy to all the previous conversations or interactions, and they'd have what's in the notes and what needs to happen the next 2 weeks.
Absolutely. Yeah, to address your first point about the attorneys who may not be as responsive to emails, I can sympathize with that, and it comes with, frankly, it comes with getting too overloaded and maybe not having the infrastructure to support the volume. And so I think we can all relate to that to a certain extent. There's been times when we're just slammed, and you don't give the things the attention that it deserves, but that should be the exception and not the rule. And another thing I would say is knowing when to use an email and when to pick up the phone is a big thing.
That's a good one.
Right. And so I'm a big fan of like if you're having 2, 3, 4 emails on a single issue, and the parties are just kind of talking past each other, that's when it's time to stop, put down the keyboard and pick up the phone and just call. So look, let's figure this out, you know. And sometimes you can figure something out in a 5-minute phone call that would have otherwise taken you a day of back and forth emails.
And especially when it's a tense issue, one thing I've noticed with me is if I'm trying to get things done quickly, I may send a short, curt response, not because I'm trying to be, direct, but just I'm trying to be efficient.
Right.
And I want to make sure this gets covered and gets out. Whereas if I picked the phone up, it would have came across differently.
Absolutely.
So it may be left to assume what I meant by my words, or if I was communicating, especially when communicating what one person said to another person. So the seller wants me to respond to the buyer with this. The buyer wants me to respond to the seller with this.
Yeah.
It's very important sometimes to pick the phone up and say, hey, here's the conversation in its entirety I had with the buyer. How do you feel about that? What are your thoughts? What are your concerns? Versus like direct bullet point email, I fire off, then move to the next task. This isn't a conveyor belt business we're in. In what I'm in as the broker, it's very much relational, personal, and having to understand what the parties are fearful about, how they feel about it, so you can get that deal to the closing table.
100%, yeah. One other thing I would say on the lending front is if you can avoid trying to make the lender the bad guy, that's a good thing too to try to avoid. So what I mean by that is if like everybody starts ganging up on the lender, hey, you're screwing up the deal, you know, it's not good. You know, you don't want the lender to be adversarial with you. You want the lender to be cooperative. So you want to just keep them involved and let everybody know that they're on the same team too. I mean, they want to close deals. They want to write loans. They're in the business of writing loans. So
I've made that mistake. I've had something to prove before, and I was certain I was right, and I've went at it with lenders, attorneys before, and for to no benefit of my own. But I've learned now just to, like you said, pick the phone up and call back. Hey, can I ask you why are you asking for this? Yeah. How can we work around this? Because a lot of times what it is they have a framework that they operate within. We need all of these things. Like we had a deal, maybe you remember a few years ago, transportation company, and the lender had given us a thumbs up 2 weeks before closing. Their underwriting department said, hey, all stop. The tax transcripts do not match the returns. Do you remember that?
I do, yeah.
And the attorney, it was basically, this is not going to work. Figure it out. So what ended up happening with that deal is what we didn't know. This is important to know, that things that kill deals. The accountant, to be helpful, filed a placeholder return with all zeros so that they didn't have to file an extension, and then they amended the return by mail. So they e-filed the placeholder return to get a return in. It didn't have all zeros, but it had enough information, but it wasn't accurate. To buy them time to do the amended return. So I don't know why, because you're still going to pay. I think you'd pay interest either way. But
it made sense to the accountant.
It made sense to the accountant. But what people don't realize is when you e-file, that gets transcribed immediately because it's e-file. But when the e-file window closes, you have to mail it in. It sits in a box for sometimes 6 months before they can actually add it to the transcripts.
Right.
So they may have accepted your payment, they may have recorded, but it's not on the transcripts. It appears. Again, I'm not an accountant. This is just for entertainment purposes only and educational purposes. But what we ended up having to do is get a CPA letter from the CPA stating, hey, we have the receipt from when the client paid, we have the check stub from when they paid their taxes, we have both copies, and then a CPA letter saying that, this is actually what happened. Yeah. And so it just took getting on the phone with all these parties to make that happen, and then that deal ended up closing.
Yeah. Yep. And that's what it takes sometimes, is just getting people to see past the issues and see each other and work cooperatively.
Right.
For sure. Yep.
What are some other things that you see become obstructions and deal killers or get deals off track outside of buyers, sellers, and lenders?
So we talked about unrealistic time expectations. I think that's the other big one is just wanting the deal to close too fast or expecting it to go too slow, maybe even. Sometimes you have big buyers that are in the business of buying small companies, and that's what they do. It might be a private equity company, and they approach a seller, and they give them a letter of intent, and the seller's like, well, this looks great, and they don't read the fine print that they're looking, that offer that they're making is really not an offer at all, because there's so many outs for them, right? Mm-hmm. And there could be the purchase price being paid via earnouts, so they're not getting a lump sum at closing. They're going to get paid over time, and so if the seller's not reading that carefully, they may have a totally different idea of the deal that's happening. Then they might get under contract, a couple months go by, and then the buyer says, hey, you know what, we're going to back out. Now the seller's just wasted several months, and they thought this deal was going to go through. They thought they were getting one thing, and turns out now they're not getting anything. So that goes back to making sure they have a good broker like yourself that can make sure they're vetting the offer.
Well, one thing I've seen too is when a buyer, and buyers are not going to like what I'm about to say, when a buyer works with a seller directly without some type of intermediary in place, the buyer has all the time in the world and all the leverage in the world to make their decision. There's no mechanism to create competition, so they can drag a deal out for as long as they need to. There's several times we've had clients come to us and say, well, we have buyers coming to us. Why do we need your services? And I'll ask, okay, how long have you had these conversations, and why haven't they taken you to the altar yet? Why don't you have a ring on your finger? Why isn't there a contract?
Right.
Because they've got all the time in the world to make a decision if they want you or not, and they have all the leverage. So that deal will drag on and on and on and on if you don't have some type of intermediary to be the catalyst for momentum and competition to get the deal moving. Because sometimes people have the best of intentions, but they're just used to taking as much time as they want.
Right. Right. And that's 100% true. And I've seen it happen with clients that we represent on the legal side. They get approached and they don't, for whatever reason, involve us right away. And they just come to us later after they've already signed something with buyer, a letter of intent. They're saying, hey, we're going to sell. And I look at the deal and it's like, oh man, this is probably not what you're thinking it is. And so sure enough, we've had several where it falls apart after a few months. The seller's emotionally drained because they're getting their hopes up. They're getting emotionally invested in this idea. Now they're starting to envision themselves on an island drinking an umbrella drink, fantasizing about having this money in their pocket, and then it doesn't happen, and it's emotionally draining for them. And so that's usually when I say, hey, look, I'm sorry that happened. Let's talk about the future, though. Have you considered talking to a broker? And the reason why is so that you can prevent this from happening again, and make sure that the deal's or an offer is actually vetted and it's the right thing for you.
Right. And a broker working, and in unison with their attorney as well, because we are not able to advise them on the transaction side as far as the contract language. We can tell them the basis of the offer and the financial side of the offer. I think expectations are very important, and that's why it's so valuable to have a conversation with an attorney, a broker, your accountant, a financial advisor on how much money you need for retirement. Because I think a lot of times sellers want to price their business on how much money they need, not what it's worth.
Right.
And one of my pet peeves with brokers is when and this is a rabbit trail, but I think it needs to be said because this kills deals. When a broker entertains a seller at an asking price that is not reasonable or achievable by any means, let's say, double what the expected asking price would be. Even if the seller does not sign that listing agreement, they now have it in their head. That's what their business is worth. So now they go through growing and structuring their business in a way that this is what the exit I'm planning for because it's worth this much. And so they may go 5, 6, 7, 10 years without properly preparing for what size exit they need. And then they try to go to market at that price or that multiple, and then they come to find out that, the business isn't selling or the deal is not staying together. And it's because they had this unrealistic expectation and this target that's not achievable. So now they have set their whole retirement plan up based on that target.
Yeah, and that could be particularly catastrophic, if they're nearing retirement already, right? And they're really counting on that money. And so, yeah, I agree with you. That could be a big problem if they have unrealistic expectations about what the business is worth. So it really does well to take your time in setting that up before you go to market. And I've seen you do that. I've seen brokers maybe not do that so well, but taking your time and making sure it's priced right, marketed right, so you're attracting the right buyers. That's everything.
And even if the seller wants to go to market at above market price, you're being very clear in communicating. And I had this conversation yesterday with a great client. He's got a great business. And the conversation, he's interviewing brokers. And what I told him was, I said, this asking price, I think it will take us 1 year to 2 years to get, because it's a large margin above where I think the market will currently bear. And your business is fantastic. It's just this industry doesn't pull that high of a multiple. And it's still, he's able to achieve a 4+X multiple, but other brokers have told him numbers that, are in the tech space, right? So in the almost like these 7, 8, 9, 10x, which, if you have a tech company, I mean, you can go buy Chevron for a 8-to-1 price to earnings ratio, right? So an 8x multiple on Chevron right now. So knowing where your price expectation should be and knowing that, okay, we can still achieve this, but it's going to take a lot longer so that you're going to be on market for a year, 2 years to maybe get that number, and maybe you'll grow into that number. One thing I have on here I want to talk about, because it doesn't come up often. When it comes up, it creates a lot of obstacles, is outside parties. May that be a barter relationship you have. Like I had a deal recently, I started talking to the seller, and he, as we're having this conversation, like, well, I trade this for my landlord and he lets me rent here for that. And then, my uncle is my landlord and I pay him like this much. And then my, another supplier does this. So we barter for this, and how those outside relationships are going to affect a transaction, because they're probably not going to convey with the business.
Right. Yeah. Yeah. That's a great point. And so that's something that our team would do, or I specifically will do as soon as I get involved in a transaction. Let's say it's still at LOI negotiation phase. How does this business operate? What makes it go? What are the vendors you use? Who are your customers? What do those relationships look like? Where do you live? Where does the business live? Does it rent? Does it own? Okay, let's take a look at the lease. Is it assignable? Do we need the landlord's consent?
That's a big one we haven't talked about.
Yeah.
Leases.
Is there an assignment fee? Is this an institutional landlord? Is this a mom and pop landlord? Are they familiar with assignments? Are they going to take 6 months to consider it? Are they going to give it to us right away? That's a big thing right there. Because if the lease is going to convey as part of the deal, then you need to know that you have the ability to do that. And same thing with vendor relationships or what anything like that, where there's maybe a bartering relationship. Is there a contract that memorializes that? Can we get a contract in place prior to closing that will convey with the deal? So all those things need to be nailed down. The one sure and fast rule is if you do nothing and do not nail those things down, it will be a problem at closing.
Right. And leases, I think, is a whole podcast episode in itself. There's language so when you're reading as a broker, when we read a lease, we go straight to the assignment section. That's the first thing we want to look at, and there's a clause usually that says will not be reasonably refused. I think
unreasonably withheld.
Yeah, unreasonably withheld.
Or if you want to get really pithy, unreasonably withheld, conditioned, or delayed.
Yes,
us attorneys love those couplets and triplets.
When that is not present, the landlord can carte blanche not renew that or not assign that lease. It's to their full discretion. They can renegotiate the rent. They can renegotiate CAM. We've seen that happen. And I think a lot of times when I tell all of our clients, if you're ever signing a lease, it doesn't matter if you're signing with a family member, you need to have an attorney look over it, because they have the lens to look through that lease to know, okay, 5 years down the road, how is this going to affect the business?
Yep. And I've seen it go both ways. So like I said, if you've got a large landlord, maybe they've got multiple properties and shopping centers or whatever the case may be, they are used to doing assignments, right? And so they've got a process, and I've seen it work very well. You submit an assignment request, they say, okay, great, let's see the financials for the buyer. We'll have them execute a new personal guarantee, and boom, and you sort of get a rubber stamp. Other times it's the opposite, where the landlord's never done an assignment, and maybe they have one property and it's a small family, and so they're like, whoa, assignment, what does that mean? We were leasing to you, we don't know this other person. And so, everything boils down to what does the lease say? If the lease is silent, then, there's a few ways of looking at that. If it's silent on assignment, then potentially the tenant or the seller could go ahead and assign it upon notice. If it says that you have to get the landlord's permission, period, then it's going to be like what you said, where it's going to be very one-sided and we're at the landlord's mercy. And so we need to start that conversation early on with that landlord to make sure that we're going to be able to convey at closing.
We've seen things in the past where you have leases that have ambiguities in them because dates may be wrong. They may be written and numerically different. We've seen that before. We've seen where the entity name may be wrong. And so then it comes into question, does the seller have right to the property, right? Or does what's enforceable? So it's good to have those items looked at ahead of time. And also you mentioned something that brought up a past situation, knowing what the financial requirements of that lease will be, because we had a deal we were trying to work probably 2019 where the landlord wanted this huge personal financial statement from any tenant coming in. And so even though the lease was only $3,000 a month, they needed to have $250,000 cash in the bank to assign that lease. And that now made the pool of buyers a lot smaller, because additionally, after closing, they had a post-closing liquidity of $250K just to qualify for the lease.
Yeah, and that's true. And to be honest with you, when I'm representing a landlord, we try to include as many of those clauses as possible. And if the tenant's represented, we might have a conversation about that. But a landlord wants to make sure they have as much control as possible on the assignee. Conversely, the tenant wants to make sure they're not in a situation where the landlord can just say, "Nah, we don't like the way that person looks. We're not going to agree to the assignment." There's a particularly problematic provision in a lease on assignments where it says that if the tenant attempts to assign or tells the landlord that they want to assign, the landlord at that point has the right to terminate the lease. And that could be a real big problem too, especially if the landlord and tenant don't get along, because they will use the request to assign as the impetus for getting rid of that tenant.
Especially when you're looking at businesses like laundromats or restaurants that are very much leasehold improvement specific. There's large investments in that space. And so the business is that space, right? It's a geographic location, and those sellers need to protect themselves and make these provisions ahead of time and know, okay, this lease conveying is going to be the most important thing in the business transaction outside of even the financials. And so knowing that ahead of time and speaking with an attorney, I always say you need to have a attorney number 1, accountant number 2, financial advisor number 3 in your corner if you own a business. And then a business broker when you're getting within, I'd say, 5 to 10 years from retirement, at least have the conversation, take them out to lunch, something. So you at least know what to expect.
I think the best time to look at talking to a business broker is when you're not looking to sell, when you're still maybe years away from thinking about it. Talk to a business broker and figure out, what could my business sell for? And if I need a certain amount to live off of in retirement, then what do I need to do now to get me to that point so that I can go to market in 3 years and get it?
Right. I feel like we've done a good job covering most of the issues that come up. Is there anything you can think of we can add?
I'm sure I'll think of something as soon as we're done today. There's just so many situations. I think it all boils down to good communication, good expectations, be reasonable, be ready. If you're the seller, know why you're selling. Be prepared to invest a lot in the personal relationship with the buyer. One thing we didn't touch on that I'll mention real quickly is, in the majority, in fact, I think almost all of them, every single deal has some kind of post-closing obligation of the seller's principal to continue participating in the business. And that might be 2 weeks, it might be 6 months, it might be a year. Depending on the nature of the business, the buyer may need the seller's principal, the person who's really been doing the work and making it happen, to stay on and coach them how to do the work. Well, if the seller and the buyer hate each other, how is that going to look? You know what I mean? And so that's something to think about. Like, if you really have to like this person, you have to be able to get along with them, because in most situations, the seller's going to have to stay on after closing for at least some kind of coaching and training familiarization period. And so, they can't be at each other's throats. Right.
We didn't spend a lot of time talking about the buy side. So on the buy side, I think a lot of buyers do a good job with this, but getting pre-qualified before you start business shopping, talking to an SBA lender, knowing what the financial requirements are going to be. There's oftentimes we'll have a buyer inquire on a business, and then we always ask what their cash position is available to invest in the company. And oftentimes they're a little short on what they need. And so we coach them on that and say, okay, so you want to get an SBA loan. Well, you need to talk to an SBA lender, but roughly you need 10% of the transaction cost, the equity injection available, and you have to have some post liquidity. So if you only have $50,000, you can't invest $50,000 in the business. You need to have something left over after closing. Because in case you need money to live off of outside of just the business, in case there's a month or two the business is down, right? And lenders are looking for that. And also understanding that most sellers are not going to finance at SBA terms, and I think some buyers, they come into I see this online. There's so many coaches, consultants that are teaching buyers how to buy businesses, and they're on the topic of how to buy a business with no money down, not using your own money, all this very grifty stuff that's not true. I mean, I've yet to find a seller motivated enough to sell his business with no money down, finance it from a buyer. I've yet to see that.
If there was one, I would be concerned.
Right. What are they running away from? What liabilities are out there? Is there a pending lawsuit coming? Right. Yeah. So, understand that from the buyer, for the buyer, sellers are not going to typically give up their business for the same terms that an SBA lender is going to. And maybe you might find a seller who's that motivated to retire, but to your point, what's lurking in the shadows you're not seeing yet.
Right. Yeah, you're talking about seller financing specifically.
Mm-hmm.
Yeah, so I mean, seller financing is a great option when there's a gap and we need to cover it, where the third-party lender can't get us all the way there. Sellers should be open to that idea, certainly, and if they're not already thinking about it, that's part of the education process to say, hey, it might come to a buyer who can make it work, but they're going to need a little bit of help on the seller financing, so be open to holding paper on that. If a seller is really motivated to sell, there could be very good reasons for that. There also could be some bad reasons, mm-hmm. and so if you're a buyer, right, you need to nail that down. You need to understand, okay, what is motivating the seller to sell.
Mm-hmm. Yeah, and to the point on seller financing, one thing I'm seeing is with interest rates rising, it's becoming more crucial for sellers to participate in the lending in some ways. That may just be a small seller note, but also maybe a small seller note on standby.
Sure.
Which means no payments can be received on principal during the time of while the loan still has a balance with the lender.
Yeah.
And understanding that as a seller, that when we start pushing into the higher range of the multiples, the amount of cash left to cover the debt, it shrinks. So there may need to be some participation from the seller to make that happen.
Yeah, and sometimes a buyer doesn't actually even need the seller's cash, so to speak. They don't need a seller note, but they'll still ask for it for indemnification purposes. Mm-hmm. So they'll want a seller note for a small percentage of the deal so that they have some kind of recourse if an issue does arise, a claim does arise, and right. They can set off their damages from that note or stop payments and have at least some kind of buffer there for their damages. So again, buyer may just even say, hey, we want a seller note just so you have some skin in the game post-closing.
Right, which it shows the buyer that the seller believes in the business. When the seller's not
Sure.
willing to participate post-closing, it sometimes raises some suspicions that there may be, the business may fall apart after the sale.
You're right. Yeah, absolutely.
So to wrap up, we had some questions from previous episodes. Some of our listeners wanted us to go over, and I've been saving these for this conversation because I thought you'd be the right person to ask these to. So a friend of ours, Jason Javera, asked, how do you negotiate?
In good faith. It's a very lawyerly answer. When you negotiate, I mean, you need to know what is a want versus what is a need. You need to know what is a position versus an interest. And so what I mean by that is we all have these things that we say we want, but when you look at it, is it something you actually have to have, or is it something that you just have been coached to say?
Yeah.
So, and again, a lot of variables here, right? But if you're a party to a deal, you have an idea of what you should be negotiating for. And that's influenced by so many things, books, TV, other professionals, podcasts that they're listening to, and they have ideas about what they should be negotiating for. But you need to be willing to be wrong, and you need to be willing to reconsider what you think is most important. And so somebody who's really good at helping parties negotiate will be able to peel back the layers of the onion and look at, okay, here's what they're saying, here's the position they're taking, but what is the underlying interest? I had the benefit of doing mediation. I was a certified mediator for a number of years, and that's something mediators are trained on, is when you have two parties who are adversarial and you're there trying to help them to see each other as humans, really, peel back the layers. They're saying they want this, but what do they actually want? They may say they want $5,000, but what they really want is vindication. They want an apology. So that's within the context of a mediation, but that applies to business negotiations as well. Mm-hmm. Figure out what do they really want, what's motivating them, and let's get to that as quickly as possible.
That's a great answer. I'm a big fan of what Chris Voss talks about in his book, Never Split the Difference, in negotiating.
He's the hostage negotiator.
Right.
Yeah.
And it's almost like, well, I won't use that example, but it's basically comes down to communication, understanding what the other party is most interested in. And then how that aligns with what you're interested in. So, or the other party, if you're an intermediary, you're trying to bridge the gap of communication so that the parties can get to both what they want and they both feel like they're getting a win. If you feel like if you have to twist someone's arm, it's not like buying a car. Right? You go to buy a car, you're adversarial with the car dealer, and it's not a cooperative experience because you're not coming back. Typically,
yes,
you're buying a car and you're leaving. You can't take those type of positions in negotiating a business relationship. It just doesn't work. So I think understanding the position the party's coming from and finding a way to get a win-win, but still without giving up what you want.
Right.
And then you may also find out that what you want may never align with what they want. So is there a time to walk away? And I think, I can't remember if it's a Mark Cuban or Warren Buffett quote, but the best deals in business are sometimes the ones you walk away from, or best investments in business, the ones you walk away from.
Yeah, I couldn't agree more, and yeah, I think everything you've said is accurate, and yeah, hopefully that answers Jason's question, and every negotiation is a little different, but yeah, if you can see what are the parties most interested in and try to get to that as quick as possible, then you're going to save everybody some time.
Right. Jason, another question, how to close someone on a deal, how to get actually...
Well, I'm going to point to you for that because, to be honest with you, my job usually is not to persuade.
Right.
It's maybe to reveal facts or truth or things that are the person's not thinking about. But I don't typically try to close anybody on a deal, because that's just not the hat we wear. I would be interested to see what you have to say about that.
The simple answer is a party has an interest in something that you have, which is why they've come to you, whether that's if you're trying to sell them a physical thing, if you're trying to sell them your services. So what I always look for first is what is their motivation? Why are they interested in this? And then I'm looking for all the reasons they would say no, and I'm asking myself if I can provide those answers. So, for example, if someone has an objection on price, is it an objection or is it a complaint? Do they really have a limited budget, or they don't want to pay that much for the service or the product? What's their underlying motive, right? So what's the most important thing to them? And then we're going to keep discussing that and moving towards that. Like Jordan Belfort talks about the straight line method. So you're asking questions to get enough information to get through an objection, and you're asking for the close. And then when they give you the objection, you're now addressing the objection. You have to, when you're being ethical, you have to address it objectively. Okay, is this a objection or a complaint? Mm-hmm. Because if you're transparent, you'd say, well, address it like it's a complaint, right? Yeah. This business may be more expensive, but does this business stand out from all the ones you're looking at? Yes or no? Okay.
Yeah.
If no, well then, okay, maybe this isn't the right business for you.
Yeah. Yeah.
Or, same thing with services. Okay. I always ask clients, how important is this to you? If they ask us about it, they're talking about a fee, right? And how much do we charge? Okay. Let me ask you a question. You get to do this once. How important is this for you? If it's not that important, then don't do it. Then find someone else. But if it's important to you, it should be something you're willing to invest in. So it's speaking to the objections and speaking to their concerns and addressing them ethically and honestly. And they may not be a fit, and you may not be able to close them. Yeah. But I think that's, at least for me in my life in sales, what's produced the best results.
Yeah. No, that's great. And as I think about it, I do a similar thing when I'm representing a party and we're doing the closing, or maybe we're just representing the party. And I like that methodology of trying to identify whether it's an objection or a complaint. Sometimes somebody just wants to vent and they just need to be heard. And so we'll play that role. We'll listen to them and hear them out. Okay, I hear your complaint. Let's talk about that though. And for instance, in a situation we had where a seller was sort of griping about the fact that the buyer's lender was taking too long and we had to do a few addendums to extend. They were just really getting upset. And I said, okay, well, let's think about this for a second. Does the deal that you signed 2 months ago, is that still the deal you want? And do you like this buyer? Do you think they're the right fit? And if this deal blows up today and you had to go back to market, and you had to get another buyer under contract, and you had to get to where this deal is right now, how long would that take, right? And so the answer is it would take another 6 months. And so you have a 30-day extension addendum versus going 6 months with a new unknown quantity. Obviously, the 30-day extension addendum makes sense, right? And so that was a situation where we had to identify, okay, this person just really needs to vent and to get this off their chest, and we'll help them with that. but then let's figure out what is the actual issue. Is it just a complaint, or is there an actual objection to the deal?
Yeah, and then to summarize, I guess all closing is asking questions, making observations, and then repeating that information back to the party and asking the right questions and asking for the call to action. Okay, can we move forward?
Well said.
I think that's the one thing I see people who struggle in sales. Their one hang up is the confidence to ask for the call to action, to ask for the close, because they'll go through all the steps of following up and communicating well and asking good questions, and then they'll wait. They'll wait for someone to they may be shy or they may be fearful of rejection, because in sales you're going to get a ton of rejection, but they're not asking for the close. I think that's the biggest thing. Just ask.
Very well said. Yeah.
So next question, our friend Aaron Preston asked, if a business owner has terrible books and financials, can they sell their company, and if so, how?
Well, I'm going to have to look at you for this one. I think, and this may come as a shock to some people, but I don't love accounting. And we have to be familiar with accounting just because of the nature of what we do. But I personally don't love accounting and don't love reading financial reports. But that said, I think in broad terms, if a business owner has terrible books of financials, they may still be able to sell their company. It just may not be for what they want and when they want. They may have some homework to do before they can get to that point. It may change who their potential buyers are too. And this is kind of a takeaway from like real estate, residential real estate, for instance. A home that can't qualify for traditional lending may not be an issue to a cash buyer. A cash buyer may say, yeah, this has some issues, right? Maybe there's an ingress egress issue. There's some problem with the property, but I'm a cash buyer. I know how to fix it. I'm okay with it, right? And so I think the same applies here. It may just really narrow down your potential pool of buyers, but it depends on the situation entirely. It could be a situation where it's like, well, we need to take a timeout. You need to spend the next 12 to 16 months and clean up things on the financial reports so that you can actually go to market in good faith and really be prepared to answer questions by a buyer.
Yeah, no, I don't think I could have said that better. The only thing I'll add is there's two things that play in a business transaction. There's the price and the time on market. Those are controlled by how many qualified buyers fit your business. So if there's more competition for your business, you can demand a higher price. Mm-hmm. If there's more competition for the business, you'll have a shorter time on market. When you start reducing the amount of qualified buyers or interested buyers, you're now decreasing the price and time on market. So when you have poor quality of earnings, you're reducing the amount of buyers who are willing to look at the business. So now you're reducing the price and increasing the time on market.
Right. Yep. And that's where it just comes down to having an honest conversation with that seller and figuring out, first of all, are you even aware of the problem? Maybe that's an issue you have to overcome right in the beginning is helping them to actually see that they do have an issue.
Right.
They may think nothing's wrong with their business. Hey, this is the way we've done it for 20 years. We write out our financial statements on paper by hand every month. There's no auditing or standard methodology for how they're prepared, but it works for us, right? So you may have to say, well, look, that may work for you, but that's not going to fly with a buyer.
Right. Well, we had a situation 2021 client we worked on together that when we reviewed their financials, we found out the balance sheets didn't balance. And come to find out, there was a large number of expenses that were incorrectly categorized and doubled in some cases. So the financials didn't balance. So they would have actually sold for a smaller price if they would have went to market like that. And then we found the error, and the accountant the new accountant corrected it. And then they were able to get a higher price.
I remember it well. And we had it
was 16 months start to finish.
Yeah. And we had the interesting opportunity to have been involved in a first deal before you guys were involved. Mm-hmm. See that one fall apart, get them connected with you guys and the accountants, and then 16 months later, now they are back to market, got a buyer, and it closed, and they got more money than they would have otherwise.
And this is a large company. It's not. Company. Yeah, so that was the thing. This is a large company. So it's not, I think, $45 million in revenue. It was their top line revenue. So this is not a mom and pop. This was a large company. We had another one that we didn't work with. We talked to them. We didn't work with them. They were a $100 million company, and they had a construction company. And construction accounting is so complicated, so complex. When you have cost-based accounting versus percentage of completion, either way, the P&L swung dramatically either way based on how the accounting was done. So if it's not done properly, the financials aren't audited for a large company. it can dramatically affect your ability to sell and what multiple you'll sell at.
Right. Absolutely.
Next question is from our friend Amanda Rupp from Rupp Realty. What's the most important thing you can gather and keep organized when you are preparing to sell your company?
Well, I think it's going to go back to financial reports. I think that's probably the biggest thing, is making sure your financial house is in order, and you've got probably, and you can speak to this, 24 to 36 months of good data, tax returns, probably more than that, but at a minimum, I think 2 to 3 years, you need to be prepared to have those viewed by a buyer. The other thing is just simply the things that make the business go. And so this varies from industry to industry, but if you think about like a construction company, for example, what do your customer contracts look like? Are they the same every single time? Are they consistent? What do your vendor contracts look like? Do you have all of your subs using the same type of contract, so there's predictability and control there? Supplier relationships, are those solid? Are those vetted? Are you using the same suppliers consistently? Are you all over the place with different suppliers every week? Those are all things that you should try to nail down in advance and have documented as best you can, because those are questions that a buyer's going to ask. So I think the best way I can answer that is, if you're looking to sell your business, try to put yourself in the shoes of a buyer. Pretend you're buying your own company. What would you want to know? What would you want to see?
Fantastic answer.
Yeah.
Yeah, employee agreements, contractor agreements, leases. Oftentimes, we've seen that at that point, the seller realizes they don't have a paper copy of their lease, and they're afraid to go ask their landlord for it, or a stored copy for their lease, and they're afraid to go ask their landlord for it because they don't want to, create any concerns.
Sure.
So just to your point, that's a good way. What documents makes the business go, and having all those in order, and then having someone review them to make sure that there's no surprises. Like we had a situation recently where there was a mutual relationship between a vendor and a seller, and then who owns the clients, and at what stage of the clients owned, and who do they have right to transfer those clients to another party, right? So that the business relationship worked for decades, and then all of a sudden you go to sell, and now will this convey with the sale? We don't know.
Yeah, very, very true. The you brought up like employment agreements and things like that, so that makes me think about internal SOPs. And so if a buyer were to walk in the door and say, show me how your business runs, without telling me necessarily, don't just tell me what you do, show me how it runs. Do you have something you can produce to them? Say, here's our SOPs for how we intake clients, how we do the work, how we sell, how we market, you know what I mean? And so can you show them those things? And if the answer is no, then that might be something you want to consider working on.
Yeah, we have this document we produced. It was an email series and a blog, and it was the difference in profit versus value in a company. There's things you can do to add profit. There's also things you can do to add value that don't necessarily add profit. And written SOPs, documentation, hiring process and procedures, recruiting process procedures, promotion, internal training, all of that is so valuable that gets overlooked. Even small companies, like we've noticed, my company, we're 5 people right now. Having written and video SOPs, there's so many free tools like Tango and Loom. You can use, well, Tango's free, Loom's not. Loom's like $10 a month, but you can record an SOP and it lives there in perpetuity. You can send someone a link or store those links inside of a Word document. And here's the training process.
Yep. It's perfect. Yeah. All you're doing is increasing value, and the more you can do that, the more your value goes up. This is especially true for small companies where the owners are heavily involved in the day-to-day.
Right.
Yeah. Because the question is, what are you selling? And if it's just, well, I'm selling my things that I do, well, are you going to stay on with the business forever? No, I mean, you're trying to sell, right? So you need to have something other than just your own time and efforts that you're conveying.
Right. One of my sayings is the value of a company is derived by the size of the hole left after the seller exits.
I love that.
So if that hole is minimal, the value of the company is large, right? Because there's less impact, because impact is risk. So buyers are looking at risk and reward. So how much risk do I have to take on to get what type of reward? And multiples are a direct correlation to risk. So recurring revenue business are less risky than project-based revenue.
Right.
The more the seller's involved with the process, and then to the point of what kills deals, the further along in the transaction process that becomes disclosed to the buyer, the more likely they may be to pull the ejection lever and punch out of the deal, right? So surprises and that may be something we didn't address really. Surprises are never a good thing in a business transaction.
Agreed. Yes. You don't want surprises. If there are surprises, they should be pleasant surprises.
Yes.
The company's actually more profitable than they initially thought. That's okay.
We see that from time to time too.
That's a nice surprise. We don't want unpleasant surprises. Another thing, and not to be redundant, but with that question specifically, thinking about selling, like, I think a good exercise for a seller would be go do nothing for a week. Don't talk to anybody. Don't send an email. Don't do anything related to the business. And could the business still survive and function without you? Now, if
it may function better.
It
Sometimes
may function
mine
better.
does.
Then that's a good thing. That's a great thing, actually. But if the mere idea of doing that, like if you would laugh at that, be like, oh yeah, right, I can't do that. Well, then you may have a little bit of work to do before you can get to the point of selling.
Right.
Or maybe not selling it for as much as you thought. So that might be a good exercise to consider.
Yeah, because like and this is another tangent, but my learning experience has been oftentimes that's my preference of how things are done, not how it has to be done.
Mm-hmm.
And then when the team's allowed to do it without me, then they grow as a team. They grow in their personal, individual capability. And they also grow in their confidence, right? Because they know I trust them. They know that I'm not micromanaging them and I believe in them, right? And so then when you as a seller exit the company, now they become the most senior knowledge holders in the company, and the buyers now look to them for advice and look to them for their knowledge and how the company operates. That's a win-win for both parties, because now the employees have that ability to be the most knowledgeable people in the company. Sure. and kind of walk out their passion and their talents inside the company, but also now the buyer has a team of people around him to help make sure the company succeeds.
Right. Yep. That's another recipe for success I've seen. Yeah. Absolutely.
The last question Amanda had was, what's most important, your gross revenue or net revenue? I'll go ahead and answer this.
Yeah, you answer that one. That's not for me.
Yes. And here's why, right? So businesses are often valued upon the net revenue, right? But how close is that gross revenue multiple to the average market? Mm-hmm. And how that plays out is when we do evaluation, we're looking at the net revenue, but also on average, what do these businesses sell for as a percentage of gross revenue? If your business, we may value it at the net revenue number, but if the number on the gross revenue is completely different, then your business is abnormal to the market. And here's how buyers can look at that either way. If your business, let's say you, round numbers, right? Say you have a business that makes $1 million in gross revenue and $250,000 in net revenue, and that business is going to sell for $500,000. Just making numbers up, right? If the subject company has $750,000 in gross revenue, but $250,000 in net revenue, it's performing at a higher margin. Buyer's going to ask why. Mm-hmm. What are you doing different than the rest of the industry? Are you paying your employees less, underpaying them? Because if I'm merging with my existing company, now I have to pay all your people the same as I pay my people.
Yes.
Or if it's the opposite and we're going to merge companies, now I have to pay all my people the same as I'm paying your people.
Right.
Are you getting a very special deal on your cost of goods or supplies? And so you're able to perform business at a higher profit margin or lower profit margin? Is there some places I can add benefit? Like I was doing a exit strategy call with a client yesterday, pull his financials up, and he went from like cost of goods was like 30% one year and it was 15% the next year. It's like, okay, what happened? Instantly, what happened? Yeah. Because that's the first thing buyers are going to look at when they're analyzing those numbers is, okay, is this repeatable?
Right.
Did the seller not order as much product and sell through inventory, so he artificially inflated the bottom line? Well, if you're not counting inventory on your balance sheet, it's really hard to prove.
Right.
So how do you walk through that process? So I would say both are important to understand what the industry norms are, so you know how aligned with the rest of the industry your business is. It's not bad being high or low. Mm-hmm. It's just we need to know why.
Yeah.
We need to be able to document that and know why you're not in line with the rest of the market.
Absolutely. Yeah. Financial reports tell a story. Ultimately, what you're trying to do
is... if they're done right.
If they're done right, well, I think they tell a story either way, and if they're not done right, then they tell a bad story or an inconsistent story at least, right? And so, having solid financials that are drafted well and done well by an accountant will tell a story. And then, if there's some sort of variance from the industry, then be prepared to answer why.
Right.
Are you guys just doing it better than everybody else, or is there some sort of blip on the radar that made you more profitable or less profitable that year? Like you said, is it repeatable? Because a buyer wants to know, can I make that magic work without you? in the time that I own it.
Absolutely. Well, I think that's a good spot to wrap it up.
Sounds good. Yeah, this has been great. And if there's any questions out there, anybody has any follow-ups or anything that they would like to reach out to us about, best way to reach us is on our website. We have our email there and phone number, so happy to answer any questions.
Which website? Let's go ahead
munizzilaw.com, MUNIZZI law.com.
And we'll also put that in the show notes. I can't recommend Justin enough. He's not only my personal attorney, he has also closed countless deals with us and also countless deals with other members of the BBF. I can't say enough positive things about you and your team. So it's been a very pleasure working with you the last few years, and thank you for coming on today.
Thank you for the opportunity. Looking forward to keeping it going. So
for everyone listening, I want to thank you all for following, liking, subscribing, commenting. We appreciate your support. If you have any questions for next episodes, please leave those in the comments on social media or in YouTube. You also can find us on YouTube, Apple Podcasts, Spotify Podcasts. But I want to say thank you for listening, and we will see you on the next episode.